Hi investors! Guess what? Our spring multi-investment review is out. So if you're thinking about making some investment in apartment buildings in Seattle or in the Pacific Northwest, this would be a great tool for you to analyze the market.
So the Seattle market is at such an interesting point right now. We kind of see it at an inflection point where we have these headwinds as it relates to economic recovery and the recovery of downtown, but then also pent-up demand for property and limits on new development that we think are going to be driving rent increases over the coming years.
This market continues to outperform the national markets. We're not in our total booming days of yesteryear, but we're still continuing to see consistent growth. Our rental growth over the past year has been somewhere around the 2% mark. Comparatively, the national average has been about 1%.
There is a ton of supply coming to market in the next year, and that has really depressed rent growth. But pretty quickly, if you look at the number of units that are in the permitting pipeline and are forecasted to come onto market really after this next year, it's really going to fall off a cliff. And because of that, we still have a housing shortage in this area, and there's just no way with the supply and demand that there can't be rent increase in 2026 and going forward.
So here at Lee Associates, we are covering 3 counties: King, Pierce, and Snohomish. In the second half of 2024, total sales volume in the Tri-County area reached $2.19 billion, marking a 94% increase from the first half of the year. We believe this is due to investors returning to market after Treasury rates dropped in September 2024. The Tri-County price per unit averaged just over $264,000 in the second half of 2024, reflecting nearly a 3% decrease from the first half of the year. There has been a year-over-year basis of a decline in cost per unit, with King County experiencing the smallest decline in the 3 counties. In the second half of 2024, the price per square foot decreased by approximately 11%. Among the 3 counties, Snohomish saw the slight increase.
The difficulties in the development world right now and all the different aspects that make those deals not pencil are really great for those in-place stabilized assets. You know, it is cheaper to buy a property than it is to replace it. Those properties are cash flowing from day one, which you are not on a development project. So when you look at that from an investor perspective, I mean, what we deal with here at Lee Associates is really those stabilized, assets that are in service, that are operating well. And I think that any investor that's interested in a product is going to be drawn to those stabilized assets.
Well, we've been dealing with several different headwinds in the marketplace over the past, call it 18 to 24 months. Those I think a lot of us can name. A lot of it has to do with inflation and higher interest rates. The effect of those has definitely pushed down on pricing and values, certainly seen much more of a focus on in-place income and performance of properties rather than the hope or expectation for improved value add components. Looking forward to the second half of this year and early 26, we expect rent growth to continue to improve as units become absorbed, the demand for new housing remains, and the supply starts to tighten back up.
So there's a lot to unpack in the spring 2025 investment review. We've got market oversights, forecasts, really great data. So really would encourage you to go to our website and have a look at the report and also our new listings coming out. Got some really nice inventory coming out here in the next few weeks. Thanks very much for tuning in, and we'll look forward to seeing you soon.